In this month's economic update, Kaplan Professional Education's Victoria Papandrea speaks to an industry economists about the short-term domestic and global economic outlook.
Welcome to Kaplan Professional Education's July Economic Update. Today I'm speaking with HSBC's Chief Economist, Paul Bloxham. Paul, thanks for joining us today.
No problem.
Firstly, Paul, let's start with Europe. Now the debt crisis continues to plague the region. What major developments do you see occurring in the Eurozone over the next few months?
Look, Europe is a huge challenge at the moment, and it really is the biggest challenge for the global economy. What we've seen is that the European economies are obviously on very divergent paths at the moment. The German economy is looking okay, but the peripheral nations are going backwards. Their economies are shrinking. Of course, they've got high levels of debt, and they are still yet to come up with a solution that really puts them on a stable footing in the medium term. What we really need to see happen is we need to see some sort of central fiscal authority develop over time, or at least plans that are set out and that are credible for a centralised fiscal authority to come into place. And then we need to see some sort of debt sharing arrangement, some sort of debt mutualisation. In particular, the way we've been thinking about this is one of almost the necessary features is once you've got that fiscal arrangement in place that's centralised, you need to see some sort of euro bond issuance so that the whole of the euro area is responsible for the debt that is currently individually sovereign debt. The situation they have at the moment is untenable in the medium term. How this plays out over the next few months is really challenging to answer because it's very much a political decision. It's a decision as to whether the euro will stay together, whether they've got enough will to keep it all together and therefore do what I've just described, or whether in fact there won't be enough will for it to stay together and we'll see some sort of breakup. Now, what form that would take is a big question as well if it were to occur, but it's certainly the case that Europe is the key uncertainty for the global economy at the moment.
Do you think a long-term fix to Europe's debt crisis involves a radical restructuring of the current European economic and political system?
Yeah, I think if the euro is to stay together, they really do need very much a restructuring. The way I think about it is this. When they put the euro together in the late 1990s, they gave them the same currency and they gave them the same monetary policy. And in effect, they also implicitly said that you must have coordinated fiscal policy. So they took away some of the sovereign right for individual countries to tax and spend as they saw fit on an individual basis. But what happened, unfortunately, is the countries didn't really realise that. They didn't realise that right had been taken away. And one of the first countries to break the rules that were set in place, the Stability and Growth Pact, was Germany. So we saw from that point forward that the rules were not necessarily followed. Anyway, the bottom line is they really have had fiscal constraints since then. They just didn't realise it. And now what we've got is a very large debt problem in many of these different countries. And what we're sort of trying to fix the house while it's still on fire. We're trying to rebuild the foundations and restructure the way the euro works while there's a financial crisis going on. And that's an extremely hard thing to do. And that's why financial markets are very volatile, they're very uncertain about the future of the euro, and I think that volatility will be with us for quite some time. What we need to see is some assertive action by the politicians to convince the markets that actually the euro has a medium-term future, and as yet, we're still yet to see that. I think it's going to be with us for quite some time, and yes, it does, in all likelihood, if the euro is to stay together, involve some major restructuring of the current framework.
Moving on to Asia, China's pace of growth has continued to slow. Now, what's your outlook for this economy over the second half of 2012 and what impact could this have on Australia?
So the Chinese economy has been slowing, and indeed a part of that is because the Chinese authorities through last year were trying to slow their economy down. They had too much inflation, they wanted to slow growth down to get that inflation out of the system, and we're seeing the effect of that in the first half of this year. A part of it also reflects that, of course, the developed world has slowed down due to the European financial crisis in particular, and so the export performance of China has slowed down. Both of those things has meant that Chinese growth has slowed in the first half of this year. Now, in our view, we think that the reversal of those policy settings, the loosening of monetary policy that's happened already, and in fact we expect a bit more loosening of monetary policy, and also the loosening of fiscal policy tools, will see growth supported in China in the second half. We think that growth will pick up in the second half of this year in China. Now, of course, that's the key story for Australia. That is a big story for Australia. 30% of our exports go to China. We're very much dependent on what's going on in the commodity price space, and that's driven, a lot of it's driven by what's going on in China. So if that is to occur, if it is the case that Chinese growth does pick up in the second half of the year, it's a key part of our relatively positive outlook for Australia. We still have in mind that we will see fairly solid growth in Australia this year and into next.
Paul, looking to Australia now, according to a half-yearly report by the OECD, Australia's economy will beat the growth rate of most other advanced countries during this year and next. What are your thoughts on that?
Well, I think we're well placed to meet that. I think we're well placed to outperform the rest of the developed world. We are firstly tied very much into the Asia story, and Asia is the part of the global economy that is growing fastest still, even though there is a global slowdown going on. Of course, we're very exposed to China. The high level of commodity prices has motivated a very large mining investment boom, which is still going on and is fairly baked into the economy. There's not much that's going to stop that. So we are going to see a key contributor to Australian growth is likely to be mining investment for the rest of this year and into 2013 as well. And then in addition to that, we've also seen that inflation has come down, which has allowed the Reserve Bank scope to lower its interest rates. And of course, the Aussie dollar has come off its peaks as well. So those two financial variables mean that we're likely to see a bit of rebalancing of growth in the Australian economy as well. We're expecting that with interest rates below neutral, that'll provide a bit of support for the housing market and a bit of support for retail sales. And with the exchange rate having come off its peak, we expect that we'll see a bit of support for the manufacturing industry and even the tourism industry as well. I think so. The overall view is Australia's growth prospects are still looking fairly good. The Australian economy is performing fairly well. The momentum through the first half of this year has been fairly good. And so we do think that Australia will outperform the rest of the developed world this year and into next.
Just finally, Paul, shaky labour market figures in the US have fueled speculation that the Federal Reserve may need to step in to stimulate economic growth. Do you think another round of quantitative easing is on the cards?
Certainly the US economy has also slowed down a bit recently. After some more promising employment numbers around the turn of the year, we've seen the employment numbers have been a bit more disappointing. We have long thought that the US growth would be pretty weak this year, around about the same pace as last year at around 1.5% is what we've had in mind. And I think at that level of at that pace of growth, it's highly likely that we see the Fed needing to do more in terms of providing support. Add to that, of course, that they've got the risk that the European financial crisis drags the global economy down even further, and that gives the Fed even more scope to consider more moves. Now, the trouble is, of course, that the Fed hasn't got a lot of firepower left. Interest rates are close to zero. They've already done a fair bit of quantitative easing. We've got a program in place where they're using Operation Twist to provide support for their economy. So there is not a lot of space for the Fed to move any further. We still expect that there might be a bit more though. We expect that the Fed probably will put in place a bit more quantitative easing. The key question will be, of course, how much effect does it have? How powerful is monetary policy in the US when they've already done so much? And we think that the effect will be fairly limited. We continue to see fairly modest growth in the US despite any Fed moves.
Well, thanks for your time today.
Okay, thank you very much.
And that brings us to the end of July PD sessions. Thanks for watching. If you have any feedback or questions, please drop us a line at pdcontent@kaplan.edu.au. I'm Ron Wilson. I'll see you again next time.